Hello and welcome to Quarterly Perspectives, second quarter 2019. My name is Justin Rice and I serve as one of the financial advisors at Personal Wealth Strategies, and I'll be your host for this presentation. The presentation is divided into two parts. The first part reviews recent asset returns, and the second part looks at recent market and economic headlines. We start our return discussion with a high-level look at a collection of major asset classes. As we can see from the illustration, stocks and bonds were both higher during the second quarter and for the year. Let's look a little deeper at what was driving the returns of stocks and bonds. We start by looking at how developed stock markets performed over the past 12 months. We can see a wide range of results, which speaks to the need to diversify. While it would have been great to have all our money invested in Switzerland, the best performing country, investing in only one country introduces the possibility that all our money could have been in Israel, the worst performing country. The dots on or near each country's bar represents how the local stock market performed over the past 12 months. In most cases, stock market returns measured in the local market currency were better than when converted to the US dollar. This is because the US dollar appreciated in value versus most currencies over this time period. A similar trend, with an even wider range of returns, occurred in the stock markets of emerging countries. Brazil had the best return, and Pakistan had the largest decline over this 12-month period. Our evidence-based investment process has us favor several factors of return. One of those factors is a preference for small capitalization companies versus large capitalization companies. History has shown that small companies tend to outperform large companies over the long term. Looking back over the past 5 years, we see that outperformance in international developed companies, but we didn't see it in US and emerging market companies. Another factor of return we emphasize is on value companies. Historically, value companies have outperformed growth companies over the long term. Yet, over the past 5 years, as you can see in the chart on the left, we see that large growth companies outperformed large value companies. When we look at small capitalization value companies in the graph on the right, we see that emerging market small value companies have done well versus growth companies. We didn't see that in US small value and international small value companies during that same period. While we expect our factors of return to always deliver positive results, realized returns are often different. This is why we diversify into multiple factors of return. Turning our attention to bonds, we start by looking at recent interest rates. Here we plot what is commonly referred to as a yield curve to show us how much interest we receive from bond investments with different maturities. The green line represents interest rates at the end of 2018, and the blue line represents interest rates at the end of the second quarter. Since the blue line is lower than the green line, we can see that interest rates decrease during the year. Bond prices rise when interest rates fall, and this helped boost bond results in the first and second quarter. We typically prefer investing in bonds that have shorter maturities and higher quality than the broad bond market. During the second quarter and for the year, falling interest rates helped all bonds, especially longer maturity bonds as seen in the graph on the left. In the chart on the right, we saw investors move back into lower credit quality bonds as stock markets rallied, yet all bond credit qualities gained during the quarter. On this slide, we look at the absolute impact of different asset classes on a sample 65% stock, 35% bond index mix. With both stock and bond markets advancing in the quarter, we can see all asset classes added to the overall gain. US stocks had the biggest impact, followed by bonds. Looking at year-to-date asset class returns, we see asset classes ranging from positive 18.5% for US large on the high end in that light blue color to 1.3% for cash on the low end in that pale green color. Maintaining a diversified asset mix such as the 65% stock, 35% bond mix shown in white, kept us away from the more extreme returns from year to year with significantly less volatility over the past 15 years. This highlights the importance of maintaining a well-diversified mix of asset classes in our portfolios. Let's now turn our attention to some of the major stories we saw in the most recent quarter. This quarter was largely defined by heightened geopolitical risks, a record-long U.S. economic expansion despite signs of a slowdown in global economic growth, and more accommodative policies from global central banks. New information comes out daily, potentially impacting the direction of individual companies and the overall market. While this collection of headlines isn't meant to explain why the global stock market returned what it returned, we present it to help illustrate that there is a lot of short-term news that may tempt us to make an investment decision we may regret. It is wise to stay informed, but we feel it is very important to keep a long-term perspective when it comes to investing. As we can see from some of the quotes, investors had to digest economic growth, potential interest rate policies, and trade negotiations. Let's look at each of these headlines to see if the concern is warranted. The U.S. just entered its longest post-war economic expansion, beating out the expansion in the 1990s. This has led many economists and forecasters to suggest that it might be time for a recession. However, an expansion doesn't die of old age. Consider that our current record-breaking expansion pales in comparison versus many other countries. 7 other countries have expansions longer than our current one, and our expansion would have to go on for another 17 years for us to match the length of the economic expansion Australia is currently experiencing. Yet, it seems economists like to worry, and some of the worrying is seen in the growing concern from the Federal Reserve. As discussed earlier in the presentation, U.S. interest rates have declined this year, and the Federal Reserve is contributing to the decline. After 0.25% interest rate increases since 2015, the Federal Reserve is growing concerned about the uncertainty tariffs will have on the economy and below target inflation. The Fed officials are starting to suggest that the next interest rate move may likely be down. The U.S. is not alone in the trend towards lower interest rates. In other parts of the globe, central bankers were also largely dovish, with the European Central Bank providing indications of a potential interest rate cut, the Bank of Japan continuing to ease monetary policy through quantitative easing, and the Bank of England putting any interest rate hikes on hold. In response to the central bank policy actions and slowdown in global economic growth, as we can see in the chart, the amount of negative yielding bonds in the world has spiked this year to $13 trillion. Which is nearly 40% of all government bonds outstanding across the globe at the end of the quarter. With tariffs continuing to make headlines and with the Federal Reserve concerned about its impact on the economy, we now look at some of the basics on tariffs. Tariffs are taxes on imported goods that are commonly paid by the companies that import the goods. Companies can absorb the tax as an extra cost, or they can pass some or all of it along to their customers in the form of higher prices. The Federal Reserve Bank of New York estimates the potential impact of the 2018 and 2019 tariffs at $1,245 per household on an annual basis. While there has been a lot of headlines over tariffs, approximately only 1/3 of all proposed tariffs have been imposed. While jobs, consumer spending, and profits are all potentially impacted by tariffs, it is clear that the current administration is using tariffs as a negotiation tool. We conclude this presentation with a little long-term perspective to keep in mind. When we think about the value of a company, like a stock, there are a number of ways to calculate its worth. One simple way is to calculate the present value of all companies' expected future earnings. Since corporations essentially have an infinite time horizon, their earnings stream goes on for decades and decades and will probably survive many of the day-to-day political and economic changes. Think of a company like Coca-Cola. How many recessions, trade fights, presidents, interest rate changes, beverage fads, you name it, has it been through? Companies must adapt to the environment they are in and rise above the noise. That is the advantage of capitalism and a key reason behind the stock market's historical performance. This concludes our presentation for today. Thank you again for joining me. Until next quarter, goodbye.